Hey everybody, welcome to the morning market briefing. It is Friday, May 15th, 2026. Almost hit you with the March 15th.
The Ides of May.
Yeah, but this is May. We sleep in May. Hope everybody's doing well out there. Ben, Tom, lots to get to today. Ben's been reading a long Bill Ackman X post. We'll get back to that in a little bit, but Trump heading back from China. Did a long interview with, what's his name, Hannity last night. I saw bits and pieces.
I watched a couple. I couldn't find it all in one place.
Yeah, it's very annoying because I guess I saw something on Twitter and then went to watch it and it was like, okay, you just got to kind of clip through a bunch of it. I thought the most interesting thing was just kind of his assessment of China wanting the strait open. They're willing to help. But it seemed very conciliatory towards Xi as kind of this blanket, yeah, they're going to help. But I don't think we've got any actual substantive reporting of what that would look like or that it's actually going to happen. So it seemed like Trump was trying to play friendly with Xi and just give him credit for wanting to try to help on something that people here certainly care about. I don't know that, I mean, China should care given the oil situation, but I don't know that it's a big driver, but curious if you guys have any other takeaways.
I feel like a lot of it was, yeah, they would help if they but we don't need their help.
It was a real let me know if you need anything kind of phrasing.
Yeah, it didn't really
like
for all the build up there wasn't a lot of.
Yeah, she offered to let us for us to let him know if we need anything. That's kind of how it felt. But yeah, there nothing real substantive. Again, pointing to the state visit in September for continued. But I mean, I guess if you look at certain periods of both of Trump's terms, simply having real FaceTime, meaningful FaceTime, ongoing dialogue, in-person conversations, it's not as frosty as it's been. So got that going for you. Did seem like there was maybe a scuffle between Secret Service and whatever the Chinese version of that is. Where they weren't letting Secret Service bring guns in.
Yeah. How you always see those videos on, I don't know, Instagram or Twitter where it's like, where the bodyguard for Putin and the bodyguard for Xi are like silently having a battle between each other, like visually, and they're like, you didn't notice this, but.
I will say it's got to be odd to be competing Secret Service squadrons.
Yeah.
Or whatever the Chinese equivalent is, because it's like you're both tasked with I have the most important job in the world, and it is protecting the most important person in the world. And then another most important person in the world shows up with a bunch of guys who are here to protect him. It's a real, territorial.
It's tough though because you've got a couple L's on the board for the Secret Service, so they've got to really be flexing right now to show strength after a couple of notable ball drops.
It's been tough. Right now we're looking at oil up about 3%. Tom's seeing a little movement on the 10-year. Futures down about 1%. How do you kind of assess what's next as all of the signs are now suddenly pointing just right back to additional conflict, it seems like, coming in Iran?
I mean, I think you got to take the low-hanging fruit. I mean, yesterday, the boys were cooking with gas. There was a lot of trading at the end of the day. I mean, it's opportunistic. We have a zillion bonds maturing today. I'm going to be in the trenches probably all of today, most of Monday, trying to get money back reinvested at these levels because we're seeing rates continue to sell off. We're doing a lot of selling on equities yesterday just because this market has been red hot, and there's a lot of companies that are up. There's some of which I would say are up for reasons I can't quite explain, and that's a reason to be selling and rotating into bonds, which are down for reasons I can't quite explain. And when you see those things on the board, rotation is the name of the game. Stock market's up, close to 10% for the year. Let's sell some equities. Let's buy some bonds. Bonds are down for the year now. At least the aggregate bond index, the muni index, continues to be strong for reasons I can't explain, while actual bond trading in munis is weak for reasons I can explain. But that gives us an opportunity. But when you look around the board, it really depends portfolio to portfolio where you need exposure, because you can get 4% on the 2-year now. That's a really nice rate. You can get 4.50 plus on the 10-year. That's a really nice rate. You can get 5% plus on mortgages. You can get well over 5% on some investment grade corporates. You can get more than 5% and buy bonds that are long if you need duration exposure. I mean, the world is your oyster, with really the notable exception of short munis, which is where everyone is crowding right now. And so we're just going account by account and saying what's the best value for this particular account, and that's the bond we're buying. And so you might see a little dispersion as to what you're getting versus someone else, but you can't look at their accounts by compliance reasons. So tough. Yeah. But we're moving around a lot just to make sure we're locking in these games for a long time, because that's what you do when you buy a bond. You know exactly how much money you're going to make. Provided there are no defaults, which is something we avoid like the plague. But it's an opportunistic time now. We've seen a run up in equities. Now's the time to trim and replant. A lot of that's going to go into fixed income.
Tom, you mentioned the short end of the curve not being all that attractive, certainly not relative to these other pockets. Are we in an environment? I was talking with a client the other day who has, potential cash needs, going out, call it 2 years. And really for the last 3, 4, 5 years, we'd be sitting here saying, okay, well, let's layer out 3, 6, 9, 12-month treasuries. Let's keep them rolling, keep them moving. Do you think the longer dated bonds, whether we're talking a 10 or even a 20-year treasury, something with a lot of liquidity, do you think we're at a spot now where it's like, hey, let's go ahead and clip this 4.5%, this 5%, and then we'll sell it when we need to sell it?
Yeah, I mean, you basically are in a position where rates have basically been this high twice. You can say, we've got to maybe a 5.25 or so on the 5-year. A couple of years ago, we got to just over 5 about a year ago, and now we're back there. And each of those times, if you had bought the long bond, you would be up because you would have amortized off that time. I was talking to a client yesterday. We bought some bonds that mature in 2054 just a little over a year ago now, and those were over 5%. And while on a price basis, they're down slightly, you've amortized off 1 full year of coupon, and those are in a positive position on a year-over-year basis. And so even though, you basically round-tripped on that 5% level, you're up. And if you do that again in another year, you're up. And eventually, because your starting carry is so high, you get to a point where your break-even point, or where you get to a point where you can't be down unless something very extreme happens. That timeline is very short. And so it basically creates a massive liquidity place while also generating a ton of yield. And so there's so many pockets like that. I mean, we've been buying TBAs, which are new issue mortgages, for the first time in a long time, because you can buy them at a discount, which means that if rates come down, you actually make more money, because if that bond gets refunded, or someone goes and they get that mortgage and then they refinance it later, all that principal gets paid back, and the spread between where you bought it, which is in the 99s and 100, you get that faster, which means your yield goes up. Your timeline for getting repaid at a profit compresses, which means that your yield goes up significantly. And so there's very few situations when that happens, when you have what they call negative convexity in bonds. And so you need that. You got to hammer that. You got to
capitalize. Yeah.
And there's so much opportunity for that right now. And I mean, it's just good portfolio management. And while it seems like rates continue to go up every single day, your cover is so high. It's the exact opposite. We talk about all the time of the Silicon Valley. Like, the break-even point on those bonds is going to be about 3 days before they mature. They're going to be down on those for 30 years and have no liquidity without taking a loss. The opposite is true right now. You're amortizing off so quickly because the starting yield is so high that your break-even point on a 30-year bond is really like 2 years. And at that point, you're basically riding scot-free for the remaining 28 years.
The other piece, Andrew, on that side, is that this is a great example of the more that we can communicate with clients, and we can tailor that portfolio to actually generate a higher income, and especially on the fixed income side. So if you don't have a cash need for 3 years or 2 years, we'll try to avoid buying you just a flat 2-year treasury or a 3-year treasury, because if you don't need cash, you don't necessarily need the coupon. So we'll buy you a 0, we'll get you a higher yield, and then you just get all the money exactly when you need it. So it's a way to basically arbitrage that, because if you buy the treasury with a coupon, you're going to get a lower yield on that. But if you're like, hey, I don't actually need the money for 2 years or 5 years or 10 years or 20 years, you'll get a higher yield, and that compounds.
Yeah, and so for like the shorthand, the way to think about it is what they call them CABs, or capital appreciation bonds. You buy it at 35 cents now, and in 20 years you get $1. And so as that time period compresses, mathematically you have to go higher. Even if there's volatility on the short end, it might go to 30 cents on the dollar, it might go to 40. But
no matter what happens,
yeah.
it's $1 in 20 years.
In 10 years, mathematically, it can't get too far from 50 cents. And in 15 years, you can't get further from 75 cents. And so that's always going up in your account. The volatility is on the front end, but over a 30-year period, it will just be up and to the right at roughly a rate of 5% a year, with some volatility. And so that's the game. And you can, get $1,000 worth of exposure for $350. So you can put, even in small IRAs, you're like, hey, I want to put a floor on one part of my portfolio. I'm going to spend $350, and one day that will be $1,000, no matter what. Because assuming the U.S. doesn't go away, that's the.
It's also a great way to lock in some long-term asset allocation discipline.
Yeah.
If I know this is appreciating, and I know that you're adding to the account, well, I can pretty easily and linearly draw out the value of this position 3 years from now, and as more money comes in, I can plan around.
Yeah.
That.
Are you going to be up in 6 months? I have no idea. Are you going to be up in 6 years? Yes.
Yep.
Period.
Been on
no guarantees. That is not investment advice.
Yeah, right. Yeah, clearly. The UAE is going to complete a new west-east pipeline in 2027. I mean, all these stories, it seems like, coming out of the Middle East, and some independent of the war, but some clearly seem focused on the future of oil. How do you kind of assess the situation where we are and what's next?
Yeah, man, I think today the market is definitely trying to price in that Trump is going to end the ceasefire this weekend. I mean, that's the big story today. I think that when was the last time we had 454 on the 10-year, Tom?
Oh, it's been a while.
And so, I think that's what's happening, and I think that countries are trying to work around it, and UAE's an example of it. So they want to just kind of go right around the strait with the pipeline and export from the Gulf of Oman. So they expect that to be done in 2027. So I think that what the reality is that the more you close off certain stockpiles, the more people will figure out a way around it. We saw this during COVID when the supply chains were proven fragile, and I think that if we had another COVID today, I think that we'd do a lot better. And we were even seeing that on the tail end of COVID because people had figured out sourcing. And we saw that during tariffs last year. They were able to change their sourcing and get around the tariffs. And so I think that this is what happens, that maybe Iran can be bully right now, but the more they press that, the more that people are just going to figure out ways around it.
We hit a 449 on 4/7/25, which was Liberation Day, basically.
So we're higher than Liberation Day.
We're higher than Liberation Day. So if you think that we are in a worse position since Liberation Day, which I would argue we certainly are not, we have much better trade deals. We have positive ISM manufacturing and services. The expectations for inflation are actually lower. You may recall that the University of Michigan was at like 9% or something at that time, and rates sold off. So the question is, if I can't point to a specific reason other than people are worried about Iran for the 10-year to be at a 454, why would I not buy bonds in anticipation of a lower interest rate environment?
I'd be buying.
I'd be buying.
I've been buying.
How much higher than? So then it was. I guess it was during the hyperinflation in like 23 where we must have been over then.
Yeah. So we hit a 492 on 10/16/23, and you may recall we started last year at a 485, and it came down. Then we had Liberation Day. It popped back up, and then we basically ground down towards the high threes. And then we've been kind of on a little bit of a backward push, but I mean that's opportunistic. And again, if you bought it 490 and now it's at 450, you made money. If you bought it 450 2 years ago, or you bought it 450 last year and you got today and you bought that bond for 5%, you've made 5%. Your principal value is exactly the same, but your duration is shorter and your coupon has been clipped. So you're not even in a loss position from the worst point of last year on the 10-year. That's bond math.
Ackman looking at a new position in Microsoft. He thinks the Microsoft 365 discounting as a byproduct of all the AI players as well as the Azure concerns are overstated. Ben, I know you were picking through his long dialogue. I guess just at a high level, anything interesting? Agree, disagree?
Azure.
or just bored.
I barely know.
It was consensus thinking. I mean, it was basically a sell side report. So I don't really think there was anything different. I think if he was saying that capital intensity is actually going to start declining and return on invested capital is going to increase, then I think that would be a little bit of an hashtag edge. But
we're edging. Edging.
But instead, he just kind of reiterates a lot of talking points that we already know.
We did get a pretty consequential Supreme Court ruling, specifically as it relates to the logistics part of the economy. Will have impacts that are relatively widespread, I would think, and I would think it'd be adverse for inflation in the sense that it may drive it up. But the Supreme Court basically came in. They ruled unanimously, which is not necessarily all that common these days, but a 9-0 decision that freight brokers, so those who are basically matching up those who need things delivered with truckers, can be sued in state court if they hire an unsafe trucking company that causes a crash. Certainly seems like there would be implications on insurance rates, probably implications on just trucking pricing to begin with. But how do you kind of parse through the winners and losers?
Yeah, I mean, the reason I talk about freight is because it's the cardiovascular system of the economy.
Let's go.
It moves all the products that we consume and the food and it touches everything. I mean, there was a reason that for many years people always would talk about the Dow transports, because those were, as the Dow transports went, the U.S. economy went. I think this is going to be potentially inflationary, especially as insurance premiums re-rack going into 2027. So I don't think it'll be an immediate thing, but I think in the immediate term, what we will see is brokerage firms move freight to the biggest carriers with the best safety records. And I think that because they don't want to get done in by hiring some small trucking firm that doesn't have extensive safety records, doesn't have extensive safety checks, that if you get hit by a Knight Swift truck, you might sue Knight Swift. You probably wouldn't go after the brokerage company because you're going to get a lot of money regardless. But if you get hit by a mom and pop trucking company with a fleet of eight tractors, you're probably going to go after the J.B. Hunt broker firm or the C.H. Robinson that brokered that merchandise. So because they have the biggest pockets, or at least your lawyer's going to. And so I think this is good news for lawyers. I think it's
finally.
I think insurance rates are going to go up. I think that the consumer might get hit a little bit, and I think that the small trucking company is going to be in real tough shape.
Yeah, and especially when you just think of the overall cycle and the challenges those guys have had in the last couple of years, it's not so good for them. Next week we'll get earnings from Home Depot, TJ Maxx, Target, Lowe's, a couple others. We'll have a 20-year auction coming through on Wednesday. We'll get the FOMC meeting minutes. NVIDIA, big earnings report next Wednesday. What's top of mind for you guys?
Yeah, winners, losers. NVIDIA winner of AI. Intuit, people are talking about loser. How do those stocks trade after earnings?
Yep.
I'm very curious.
I'm interested to see what Home Depot has to say about the housing market.
Yep.
I mean,
Yeah.
they were the canary in the coal mine 6 months ago.
Yeah, 6 months ago saying
here died big time.
Here's two total sets of guidance. One for if things go the way we think they will, and it's notably worse than if things go the way they have historically. So, yeah, we'll be interested to see that. All right, we'll wrap it up there. You guys have a great weekend. We'll talk to you soon.